Recently, some of the major banks in Australia have adjusted their lending policies, making it a bit more accessible for small to medium-sized developers. In this video, I'll walk you through the latest changes so you can make informed decisions and move your projects forward with confidence. Let's get started. With the property market still moving, banks have responded by loosening some of their lending criteria. Let's break down how these adjustments from Westpac, NAB, CBA and ANZ are making development funding more accessible for developers like you. One key area where we're seeing more flexibility is with the presale requirement. Westpac are leading the charge here with a major relaxation of their presales policy. An example of which is their policy around townhouse projects. Nil presales are required for townhouse projects up to 15 lots. There is no hard and fast policy on presales. However, they have indicated that nil to minimal presales is required for most residential development projects, depending on its location, developer's experience, LVR and builder. NAB haven't been traditionally strong in the residential development space, choosing instead to focus on trading business and cash flow finance. However, they have recently eased their presale policy for smaller projects. They currently require only 50% debt cover from presales for project funding under $5 million and 70% for projects above. CBA have indicated that they have more appetite for residential development. However, they still require 100% debt cover at their maximum LVR. ANZ also haven't traditionally had strong appetite for ResDev for project funding below $5 million, unless the developer is willing to offer up all their transactional banking requirements. However, they have also eased their presale requirement to 70% at their maximum LVR. ANZ also seem to be the most comfortable with allowing mezzanine funding to help fill any gap with equity. There hasn't been any real change in LVRs, except to note that Westpac and ANZ can lend up to 80% of total development costs. Traditionally, most of the banks have chosen not to exceed 75% of costs, so this indicates some relaxation, despite the issues we're seeing with the construction industry and costs often spiralling out of control. Interest rates are relatively the same across the banks, with most choosing to price their interest rate margins over the 90-day bank bill swap rate. Margins range from 2 to 4% and line fees are around the same. Establishment fees can be anywhere from nil to 1% depending on the transaction. In conclusion, it's clear that while the property market continues to move, the major banks are responding by making development funding more accessible for small to medium-sized developers. With relaxed presale requirements, some shifts in LVR policies and a willingness to work with mezzanine funding, the doors are opening for more flexible financing options. Understanding these changes can give you the edge you need to navigate your next project with greater confidence. As always, the key is to stay informed and work with the right partners to ensure you maximize these opportunities. Thanks for watching, and we'll see you at the next one.